the investment outlook for 2018 is likely to be similar to that of 2017. We expect global growth to be dull, we expect inflation to remain relatively low, and therefore interest rates to remain relatively low. So clients are forced with the same challenges they've had this year, the hunt for income or the need for or the look for a return. However, it has to be said that equity markets this year have done fantastically well, and therefore clients should not expect another 20–30% return from Asia and emerging markets. However, we do think the underlying theme of a move away from an overweighting to US assets towards Europe and especially towards Asia will continue in 2018. We continue to expect to see the Fed raise rates, and we believe they are sincere that they would like to raise rates according to their famous dot plot. The markets at the moment do not believe that the Fed will raise rates anything like what they are expecting to. So we see two pieces of dissonance in the markets in 2018. The first is, will the Fed stick to its plan, albeit under a new chairperson? But more importantly, how will the markets respond to the increase in Treasury issuance that we will see in 2018 in the context of a Federal Reserve that will be reducing its balance sheet for the first time in 10 years? We therefore expect to see short-term strength in the dollar feed through to weakness in the dollar through 2018, but we also expect to see maybe issuance of nearly $2.5 trillion. And the key question for all asset classes is, with the US Treasury, the 10-year Treasury at something like 2.4% today, will those Treasuries be issued at a higher yield or a lower yield than they are today? If it is clearly higher, then clearly it will affect Asian and emerging market sovereign markets, and it will affect the valuation of many long-term bond proxies like the utilities and some of the growth sectors of the equity markets. Underlying it though, the prospects for most equity markets should be broadly unaffected by any interest rate rises, because they are going to be very small in the context of where we are today and where we expect the Federal Reserve in particular to get to by the end of 2018. In a nutshell, the ECB will be doing nothing next year, the Bank of Japan will be doing nothing, and I think even in China we would expect the renminbi to be the key driver of monetary policy, not interest rates. So therefore we think the background for underlying constructive equity earnings remains relatively robust. Basically what we would say is that we like the non-US equity markets for clients looking to take risk. I think there's a barbell of opportunities. Europe offers high, attractive, sustainable dividend yields and some restructuring opportunity despite the ominous clouds around Brexit at this moment in time. Whereas I think Asia and emerging markets offer the secular growth story that they always have. We see the restructuring plans in India, in Indonesia and in China as very positive for longer term returns from real assets like equities, and we would expect to see that flow through as investors become more confident, maybe that Asia in particular can to some extent benefit from a weaker dollar and generate its own domestic demand rather than relying on US consumption. So that's the barbell. In fixed income markets it's harder. There is no return from most sovereign bond markets, but we do think, even given the re-rating we've seen here in Asia, that maybe fixed income investors are going to earn their coupon, but that is it. They won't see much capital appreciation from here, particularly with the Fed raising rates and maybe with the yield curve in the US steepening. So again, that hunt for income against the need for capital return is going to balance clients' expectations of which risks they wish to run in the next 12 months. Yes, I mean, I think we've obviously been living through tremendous political and geopolitical risk. Clearly here in Asia, the geopolitical risk is centered around both the issue of North Korea, but obviously maybe the medium-term expectations of how China will deploy its economic muscle through the region using the One Belt, One Road, as well as the issues around the South China Sea and the access to the resources there. However, I think we just don't know how they play out on a day-to-day basis, whereas the key geopolitical risk that we see in the world is actually the instability in the Middle East. That could threaten to have an oil price shock on any day, and it's a risk that we think clients should manage because we are constructive on the underlying fundamentals of oil. Demand is very solid, supply is very fragile, particularly in the OPEC countries who've been very badly affected by the collapse in the oil price, and therefore we think clients should be stress testing their portfolio for a higher oil price, because that will undermine some of the positions that have done very, very well with the low oil price that we've seen in the last 3 years. We are encouraging all our corporate investments to get ahead of this AI wave rather than be disrupted by it. So there are clearly going to be winners and losers from AI, and therefore we think that the way clients should think about AI is to invest in companies across every sector who are talking about AI, thinking about how it will change their business model, rather than looking at those companies who are still trying to spell AI and will likely be very disrupted by it. Clearly, it's a winners and a losers game, and therefore we believe one of the ways to think about solving the challenge of AI is to invest in a global portfolio of securities with the winners in every sector who have already incorporated emerging parts of AI into their business models. We think this will happen as quickly in emerging markets as it will in developed markets, and it is also changing consumer behavior, because the millennial consumer, who is now increasingly driving consumption in emerging markets as well as in developed markets, is very prone to using their phone, and therefore all the business models and all the disruption around the use of mobile technology and the use of AI to facilitate that is going to be a very important driver to the global economy and to investment opportunities. In every economy in the world, inflation is somewhere between 2 or 3%, and therefore protecting the purchasing power of your wealth is important. And therefore we think inside that context, one also has to understand that we're in a period of disruption. We're seeing technological innovation, we're seeing the move to mobile phones, and we're seeing the arrival of the millennial, who is going to transition the consumer power from their parents, the baby boomers, to the future of the millennial. All businesses and all economies around the world will be affected by these changes, and we are seeing tremendous opportunities for growth, particularly here in Asia and emerging markets, as they go from no phone to 5G. Whereas in the West, what we're seeing is this slower transition because of the fact that much of the economy has been built with old world technology, and therefore it is proving harder and more disruptive to move into the 5G world. But we think this is what will happen, and it will accelerate in 2018.
Allianz Global Investors. Understand, act.